Fed Chair Jerome Powell says rates can be cut this year, sending stock markets up and Treasury yields down. Australian growth may be bottoming out. And eyes turn to the European Central Bank's rate decision tonight. We also look at why the gold price keeps hitting record highs. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior international economist Tom Kenny looks at the US government's fast rising debt and how political polarisation is affecting the US credit rating.
The debt limit's got so large, and what we're seeing now is that the interest paid on that debt is growing and will continue to grow unless that's addressed. And that means that the government has less flexibility to respond to potential future shocks.
But first in 5 and 5 with ANZ. The S&P 500 is trading up 0.8% this morning, and Treasury yields are down slightly after the US Federal Reserve's chair, Jerome Powell, told lawmakers that rates should be able to be cut later this year. Elsewhere, China's central bank president says there's room for further cuts to its bank reserve requirement ratio. Gold, too, has hit a new record high, while in the UK, the government there has cut social security contributions by 2 percentage points. A big tax cut. Focusing on the Fed, ANZ's head of G3 Economics, Brian Martin, says the markets are picking a June rate cut. But the wait for data means a July move is possible.
The committee wants to see more evidence to be confident that inflation is coming down, so it's certainly not rushing into a rate cut. The guidance from Chair Powell today was that we think rates have peaked, and we do think we will be cutting later this year, but it's not immediate at all, and that they will want to see a number of months' data before feeling confident on embarking on a rate-cutting path.
Number 2, the Aussie dollar is trading up 1.1% at 65.75 US cents at 5 a.m. Sydney, Melbourne time. That's off the back of those comments from Fed Chair Powell, which weakened the US dollar. The Kiwi as well, up 0.85% at 61.37 US cents. This also follows data showing Australia's economy grew 0.2% in the December quarter and 1.5% annually. That was as expected. ANZ senior economist Blair Chapman says December and the current quarter look to be the low point for growth.
It's been the government and business which have been driving growth, and consumers have pretty much been absent. We do expect that to change this year with the tax cuts coming through later on and then the RBA cutting later in the year. So for now, consumers aren't doing too much in terms of growth, but we do expect that to pick up.
Number 3, the European Central Bank looks set to hold its benchmark rate when it meets overnight, despite some of the more dovish members of the Governing Council indicating tonight's meeting is a live one. Here's Brian.
I think the ECB is on course to cut rates in the second quarter. I think the consensus at the ECB is to probably start that process in June once the Governing Council has had additional wage data, which won't get out until late April or early May. However, I do think that they could proceed with a rate cut at the April meeting if they so wanted to. I just think it's really now about building a consensus.
Number 4, South Korea's CPI rose 3.1% annually in February. That was marginally above the market consensus for 3%. And it's still above the Bank of Korea's 2% target. ANZ economist Crystal Tan says while core inflation held steady at 2.5%, there is still more to do.
Today's data does support the Bank of Korea's cautious stance on inflation, right? It has flagged that inflation was likely to rise temporarily in the near term and that it's still premature to be confident that inflation will converge to target.
Number 5. The gold price has been hitting new record highs, trading over $2,150 US an ounce this morning. ANZ senior commodity strategist Daniel Hines says geopolitical concerns and expectations the Fed will soon cut rates are having an effect. More investors want gold in their portfolios too. That's also a factor.
It has certainly taken us by surprise, like the rest of the market. That question about what it does going forward now that it's sort of hit those targets is an interesting one. I do feel like the outlook still remains very conducive to further gains.
Daniel Hines there. Now, on our bonus deep dive interview, ANZ senior international economist Tom Kenny explains why US government net debt is set to rise over 100% of GDP this year. That's the highest since the end of the Second World War. And he explains how that will affect the world's largest economy.
We've had a number of fiscal shocks over the last decade and a half, global financial crisis, and we've now had the pandemic, which had added significantly to the US fiscal position. So we've seen quite a deterioration in the debt situation there. And I guess longer term, there has not been any progress made towards addressing the ageing of the population there. And two significant components, expenditure components of the budget being Medicare and Social Security payments, are continuing to grow as the population ages. And unless there are some sort of revenue measures to offset those increases in expenses, or looking at some means of cutting back on those two expenditure issues will continue to deteriorate over time, just given the natural fact that the population is ageing.
Could you tell us then why we're not seeing bond yields for the US Treasury market rise substantially? Because if it was some other government that was forecast to see net debt rise through 100% of GDP, there would be mayhem. It seems those bond auctions go ahead without too much fuss. What's going on there?
Yeah, well, I mean, you could say the same about Japan as well. You've had the Japan fiscal situation is far worse, and yet bond yields there are, extremely low, historical lows. I guess in the US case, the US is kind of the currency of choice for the global economy. And so holding US Treasuries is seen as a reasonable safe haven for many countries. And that tends to, I guess, offset the negative element of, a deteriorating fiscal position.
So is it true then that deficits don't matter for the United States? They just seem to keep on going up.
No, I don't share that view, because I guess what's happening in terms of the fiscal position there is, the debt limit's got so large, and what we're seeing now is that the interest paid on that debt is growing and will continue to grow unless that's addressed. And that means that the government has less flexibility to respond to potential future shocks, and also, given that a greater share of the budget is going to pay interest, they'll have less money to spend elsewhere. And I think that has serious implications for structural growth going forward.
Can you tell us how the polarisation in US politics has affected the outlook for the budget?
Oh, it's affecting it massively. I guess, all the credit rating agencies, in terms of their outlooks for the US credit watch for the sovereign, highlight this dysfunctionality of the government position. So it's just extremely difficult for the two sides to sit down and make any sort of longer-term commitment to how spending should go or how revenue should go. So there's, they just can't get to agreement on some of the most basic things. So I think it's very troubling for the US longer term, and this polarisation seems like it's at reasonably extreme levels, and I don't see a trigger at this point in time which will turn that around.
Tom Kenny there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 7th. Catch you tomorrow with the ECB's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.